Howdy, Jacob here. Today we're looking at the Alamo Group in the machinery industry, 2.3 billion market cap, slightly higher enterprise value. They design, manufacture, and distribute services, vegetation management, and infrastructure maintenance equipment for governmental, industrial, and agricultural uses. Founded in 1955, so they've been around quite a bit. We are seeing fairly attractive growth the last 10 years. You're looking at about upper single digit year-over-year growth with both gross margin increase and operating margin increase and return on invested capital increase, dividend increase, earnings per share increase. So everything's really looking on a positive note initially. Balance sheet shows just 52 million cash on hand with 220 million long-term debt, 15 million short-term debt. So 200 million is probably about 2.5 years of their 5-year average cash flow. So we're not concerned about the debt. That's not a big deal. And they've been reducing it a little bit, at least a pretty good net reduction this year. Dividend pays out a really small amount. You're looking at a yield of 0.5% and pays out about 10 million in aggregate, which is, made 10 to 15% of their 5-year average free cash flow. So a very low figure. Majority of their cash flow is really going towards acquisitions, it looks like, and a little bit of reinvestment. And I guess just probably increase the cash a little bit. Okay. So let's start making some assumptions here. I feel like I'm pretty comfortable with a 6% growth rate. I don't mind the pretty much market average P. Hey, let's do this one above market average. Averaging 6, 5. That's what I'll do then. 6%, 5%. Share change, keep that relatively flat, I presume. 20. Yeah, they're buying back shares, but not necessarily offsetting their stock-based compensation. But we can just assume it's relatively flat. Dividend is increasing pretty heavily. Let's increase that a bit more than the revenue, just because, again, it's 10 to 15% right now. So maybe at the end of the 7-year period that we're calculating, it's more along the lines of 20, 25%. And we get to a price that needs to fall 61%. I think that makes sense to me. It is currently 17 PE, but their margins are higher than they've been in the past. And so when I take an average of what their margins have been, I feel pretty comfortable with this. Could the 8% be the new norm? Definite possibility. But for me, being a conservative investor, I use the past to come up with estimations that definitely seem reasonable and definitely seem possible. And I do think that this is a great company, one that I want to own, but it doesn't look like it's quite the price that makes sense to me. So hope you enjoy the video. Have a great rest of your day. Thank you.